It's time now for On the Radar, when we ask an investing professional what they're looking at in today's markets. We're back again with Lyle Stein. He's president at Forvest Global Wealth Management to talk about something that you've brought to us, Lyle. And this is a big divergence in debt levels in the U.S. versus Europe. We've got a graph here that we can probably perhaps begin our conversation with. You can explain to viewers what we're looking at here, and we'll move on to why it's important. This is government debt as a percentage of gross domestic product in the U.S., roughly 140%. In Europe, about 80%.
Yeah, and I was stunned when I saw this. You keep thinking of Europe being the slow growth, low growth economies in the world, which they are, and economies that had borrowed money to get through the pandemic and whatnot. Yet when you look at debt as a percent of GDP, which is the number that everybody's focusing on, I was stunned that the U.S. is 40%, 60% actually, worse than Europe. And that has interesting implications. You know, King dollar may not be so strong in a world where U.S. debt keeps going up and up and up, and there's no really indication that the U.S. debt is going to come down. No politician, particularly the two old guys, want to cut any of those entitlement programs. Interest bills are going up. If you have a lot of debt, it's a problem. And when you think about debt relative to GDP, if your debt is growing faster, or sorry, if your interest rates are growing faster than the debt, it's a problem. If you have a 6% interest rate or 5% interest rate and the economy is only growing at 4%, that debt is a noose around your neck, and that's what's happening in the U.S. today. So when you look at this, it makes a much stronger case for moving assets out of North America into safer jurisdictions. Now, is Europe a safer jurisdiction? Perhaps, if you look at debt only. But it sure surprised me as to the attractiveness of Europe relative to North America.
And when you say moving assets out of North America into Europe, are you talking about equities?
Equities, debt. You know, interest rates are lower in Europe than they are today. However, they're high in the U.S. for a reason, and it's not just inflation. It's that real cost of money that we talked about earlier. And that real rate of interest has shot up because I think investors are becoming more aware of the problems from a fiscal perspective in the U.S. What was it, James Carville said, I want to come back as the bond market and punish, back in the days of Bill Clinton. That's what's happening today, and it doesn't look as precarious in Europe as it does here.
But part of the reason that U.S. bond yields ran up this fall was the issuance of new debt by the U.S. government. A lot of bonds being put onto the market, i.e. a lot of supply pushed down bond prices and drove the yields up. Is that part of the story as well?
Absolutely, and it's not just supply, it's relative demand. And when you think about the demand for U.S. Treasuries over the last, let's call it 10 years, quantitative easing was frankly a market or a buyer of U.S. Treasury issues. You had China and Japan and the rest of the world buying lots of U.S. bond issues. They're not playing today. In fact, they're doing a quantitative tightening. They're selling. And just like the Treasury is now getting off its position in its quantitative tightening. So you've got this supply coming at the same time that there's reduced demand. Hence, you've seen the spike in interest rates. One
thing that higher yields have meant in the stock market is a lot of pressure on dividend-paying stocks. What's your view of the dividend payers? Are they priced at attractive levels there? I'm talking about classic dividend payers like the Canadian banks and the Canadian telcos in particular have been punished.
Yeah, and to me, I've been wondering about that. You always want to make sure your dividend is safe. You know, that's rule number one. What would cause a dividend not to be safe? And one of the issues is these companies that we just talked about, utilities and banks, have a lot of capital. They have a lot of debt on their balance sheets. And so the uncertainty of where they will be able to roll over that debt in years down the road comes front and center. The telcos perhaps are also suffering from the fact that people have less discretionary money. You know, interest rates are higher. Taxes are going up. They're not going down. What do I spend on my cable bill? What do I spend on my cell phone? You're going to take a little bit of a harder look. Banks are suffering the consequences of these higher rates as well, as mortgagers have to roll over and, you know, extend and pretend. The 20-year mortgage is now a 40-year mortgage. The 30-year mortgage is now a 55-year mortgage. These are problems. And we as investors are struggling with how safe is that dividend when I look forward and I see these things that might be hitting me down the road?
You mentioned utilities. That's not a case of discretionary spending. That's companies that produce oil or gas must move it on pipelines. It's a regulated industry, so there's almost a guaranteed rate of return. But we've also seen shares of companies like Enbridge and TC Energy fall as well. Classic dividend payers with very high dividend yields now as those share prices have come down.
Yeah, and again, we talked about Terra. There are alternatives. And if you get 6% on a pipeline equity or 5% on a government bond, that government bond gives you a higher degree of certainty of receiving that dividend. We believe that these dividends, TC, Enbridge, are safe. We own them. So that's our view. But let's just say it's not as easy when we can go buy 5% GIC.